The title of my report is Auditing in Context, a case study of Burberry. What is auditing? Simply put, an audit is the independent examination of financial information of any entity, whether profit or not, and irrespective of its size or legal form. When such an examination is conducted with a view to expressing an opinion thereon. And auditing serves several crucial purposes. Firstly, it verifies the accuracy of financial statements. This ensures that Burberry's reported revenue of £2.96 billion for the last fiscal year is truly reflective of its financial position. Secondly, it helps detect fraud and errors. This is vital for companies like Burberry, where the value of its luxury goods is significant. Furthermore, auditing plays a critical role in ensuring compliance with laws and regulations. Burberry, as a public listed company, must adhere to UK Corporate Governance Code and IFRS. Auditing helps ensuring these compliance, providing peace of mind to investors and stakeholders. Finally, auditing is essential for building trust and confidence. It provides stakeholders, including shareholders, investors, and the public, with assurance of the Burberry's sustainability reports and financial performance claims are reliable. The importance of audit extends beyond mere compliance. It directly impacts the companies listed on the stock market, like Burberry's success in several ways. First one is market confidence and investment decision. The second one is regulatory compliance and listing requirements. The third one is corporate governance and transparency. Auditing is not just a regulatory requirement, but a crucial practice that brings multiple benefits to the table. Firstly, enhanced credibility and trust. Independent audit opinions increase stakeholders' confidence in financial reporting. Like Burberry's last year audited revenue of £3.28 billion and the 10% growth. Operating profit of £634 million, verified by EY, provides reliable financial information to investors and stakeholders. Secondly, improved internal controls. Audit process helps identify weakness and strengths control systems. Auditing helps Burberry maintain accurate inventory control across their 517 directly operated stores worldwide, ensuring accurate stock reporting and preventing losses. Thirdly is risk management. Audits help identify and manage business risk effectively. Through auditing, Burberry effectively manage risks across their global operations, including their wholesale business, 27% of revenue, and retail operation, 73% of revenue. The lastly is better decision-making, provides management with reliable information for strategy planning. Audited financial data supports Burberry's strategy decisions, such as their continuing digital improvement and the store optimization strategy, backed by verified gross margin of 69.2% in last year. While auditing is essential for ensuring financial integrity and stakeholders' confidence, it is important to acknowledge its limitations. Firstly, cost and time constraints. Auditing requires significant financial resources and time investment. Like Burberry's audit fees for last year were £2.9 million, representing a substantial cost, while the audit process requires extensive time from both auditors and company staff. Secondly is historical nature of information. Audits examines past events, providing limited insight into future performance. While Burberry's last year revenue of £3.28 billion was verified, this historical data doesn't guarantee future performance or predict emerging market challenges. Thirdly is sampling limitations. Auditors can't examine every transaction, relying on sampling methods. With Burberry's 517 stores and numerous wholesale partners, auditors can only review a sample of transactions, potentially missing some irregularities. Lastly, professional judgment dependency. Audit conclusions rely heavily on professional judgment. Valuation of Burberry's intangible assets and brand value involves significant judgment. Different auditors might reach different conclusions about these complex estimates. I will now discuss the levels of assurance in auditing. There are two main types of assurance: is reasonable assurance engagement and the limited assurance engagement. The characteristics of both types of audit assurance are opposites. The example in auditing of reasonable assurance engagement, like annual financial statement audit, it is to provide a high level of assurance that annual financial statements are free from material misstatements, and the statutory requirements for public traded companies to ensure transparency and accountability. The other example is compliance audit. It is to verify that, like Burberry compliance with specific regulations, includes detailed examination of relevant policies, procedures, and documentation. The example in audit of limited assurance engagement is interim financial review. It is to provide the assurance of the reliability of semi-annual financial statements and conduct limited testing, analysis procedures, and management investigations. The other one is sustainability report review. It is to provide assurance for non-financial ESG indicators and reporting, with selection sampling, basic validation procedures, and literature review. To be eligible to act as an audit, an individual must meet professional qualification, membership in a professional body, relevant experience, licensing, and continuing professional education. An auditor also have the regulatory environment requirements and the professional ethic requirements. The regulatory environment have: first one is standard setting, to establish guidelines and standards for conducting audits to ensure consistency and quality. The second is regulatory bodies, to oversee and enforce compliance with audit standards and regulations. The third is legal requirements, to mandate specific audit practice and reporting requirements through legislation. The last one is quality control, to ensure that audit firms maintain high standards of performance and reliability. The professional ethics requires audit to act with integrity, objectively, confidentially, and the professional competence and due. That's all. Thank you.